want to share with everyone a chart of investor sentiment that I recently put together. I don't know about everyone else, but when you look at financial charts all day, every day, it can be easy to kind of lose the meaning behind an individual chart. And then you put a bunch of them together and all of a sudden this kind of stunning picture emerges. And that's kind of what's going on here. I'll just warn you, this chart is a little busy. I'm just going to put it up bit by bit and kind of walk through it. But all you're looking at right now is just the German DAX index, so Europe's benchmark, and we're going back 2.5 years. So everything you see is basically since COVID-19 broke out. Now, what is the profile we see in sentiment gauges? It's essentially this really fascinating round trip where we see extreme complacency before the market sell-off, extreme fear at the low during that initial COVID outbreak, and then slowly but surely, sentiment has returned to complacency over 2 years. And this first graph just shows it perfectly. This is systemic stress indicator in Europe, 15 gauges of financial stress. We've got credit spreads, volatility, liquidity, that kind of thing. You throw them all together into an index. And what do we see? No fear at the highs in stocks back before COVID, lots of complacency. Then this big spike as stocks fall, fear at the lows, and this slow progression back to complacency. So this is a contrary sentiment gauge. We see it over and over and over again. And in this case, on November 12, actually, so just 2 months ago, this indicator fell to its second lowest reading in history, dating back to January 1999. So tremendous complacency here. Now I can go through the others quickly here because they all basically show the same profile, right? Here's consumer confidence. We've inverted the scale so it aligns with the others, but we see high confidence just before the crash, low confidence, fear at the bottom, and then back to this massive confidence today. Consumers actually show more confidence now about the economy than they did in February 2020, just before stocks crashed. Options traders, same thing. Implied volatility here. You can read about IV on your own, but options traders are less fearful about a market sell-off today than they were just ahead of that 40% crash 2 years ago. Here we have bond investors, same profile, right? This is a spread between junk bonds and German bonds. Back in May, the spread narrowed to 49 basis points, right? The current spread is less than 100 basis points. So bond investors are so complacent, they're lending to Europe's riskiest debtors at nearly the same rate that they're lending to the German government. This is just astounding to me. The spread was 4 times higher 2 years ago. And finally, yields on cocoa bonds. Read up on COCOs if you don't know what they are. Some of the riskiest debt, basically they convert into equity when a bank gets into trouble. Yields were down to 3.1% in September. That was an all-time low. They were nearly 5 times higher in March 2020. Everyone believes this bank debt is safe. Our view is that it is riskier than ever right now. So there it is. You can see everything together now. Again, these are contrary gauges of sentiment. And really, a picture here might as well be worth 100,000 words. You have equity investors, consumers, bondholders, option traders. Nearly everyone is showing record or near record levels of complacency. And as Elliotians, as socionomists, we kind of know the reason why, right? The reason is that stocks are completing a fifth wave up at multiple degrees of trend, and optimism is rampant. We see this over and over and over again. The bottom line is that 2022 could get very, very interesting.